Imagine this. The Federal Reserve has paused rate cuts, inflation is still sticky, and tariffs are back on the table. Every headline screams uncertainty. Meanwhile, stock markets swing wildly, and crypto? It's cooling off after a huge run, but things may not be exactly as they seem. Feels like deja vu, right? But here's the kicker. Historically, some of the biggest crypto rallies have started right when things looked their worst. In fact, after the 2018 bear market, Bitcoin surged over 300% in just the next year, all while most people thought the market was done. My name is Danilo, and today we're diving into why 2025 might not be the disaster people fear, but actually one of the best setups we've seen for crypto in years. From macro moves to liquidity shifts, I'll break down exactly how this could play out and how you can prepare for it now. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Right now, the global economy feels like it's walking a tightrope. Inflation, while trending down, is still above the 2% target central banks want to see. In response, the Federal Reserve is holding interest rates higher for longer, a move that keeps borrowing expensive and liquidity tight. At the same time, tariff talks are heating up again, with the US pushing new proposals aimed at protecting domestic industries. But tariffs don't come without consequences. They drive up the cost of imported goods, squeeze corporate margins, and force consumers to spend more for less, effectively acting as an indirect tax. The result? A slowing, jittery economy. Investors are cautious, growth is uneven, and we're starting to see certain sectors, especially manufacturing and real estate, feeling the squeeze. This is what's often referred to as a rolling recession. Instead of a sharp, immediate downturn, different sectors take turns slowing down. It's not a full-blown crash, but it does create enough uncertainty to keep money on the sidelines. Now, you might be thinking, okay, Danilo, but how does this macro stuff actually affect my crypto bags? Well, here's where it gets interesting. Historically, these periods of tightening don't last forever. Eventually, the Fed's hand is forced. Rising unemployment, sluggish GDP growth, or worsening debt burdens typically push policymakers to pivot, cutting rates to stimulate the economy. And when rates finally drop, liquidity floods back into the system. For traditional markets, that's a green light, but for crypto, it's even more pronounced. Crypto thrives in environments where money is cheap, investors are more willing to take on risk, and there's a hunt for outsized returns. Think back to 2020 for a second. When the Fed slashed rates to near zero, Bitcoin didn't just bounce, it surged, rallying approximately 300% that year alone. Solana's total value locked followed a similar trajectory, surpassing $2 billion by mid-2021, fueled by the sudden availability of cheap capital and rising risk appetite. DeFi protocols expanded, NFT markets boomed, and meme coins ran wild, all driven by liquidity. And here's the thing. Many of those same ingredients are quietly stacking up again today. It might not feel like it yet, but the longer rates stay high, the closer we get to that inevitable pivot point. And when it comes, crypto is one of the first markets positioned to catch that wave, especially with institutional interest, ETF approvals, and broader adoption higher than ever before. Let's zoom in on something you might have heard tossed around lately, this idea of a quote rolling recession. Instead of a single massive economic crash, different parts of the economy slowed down at different times. Over the last year, we've seen manufacturing, housing, and even retail sectors each take their turn struggling. But here's the key. While some sectors are cooling, others like tech or services keep chugging along. It creates this really weird, uneven economy where things feel fragile, but not fully broken. Now, most people see that and think it's a sign of a pullback, but legendary investors like Cathie Wood are looking at it differently. She's argued that this rolling recession is actually setting up something called a deflationary boom, a period where prices stabilize or fall, technology and productivity accelerate, and economic growth kicks back in faster than expected. So, how does that tie back into crypto? Well, think about what happens in a deflationary boom. Lower costs, falling inflation, and improved efficiency mean central banks can finally loosen up. Interest rates get cut, borrowing gets cheaper, consumers and businesses have even more room to spend and invest. And all that extra liquidity, it doesn't just flow back into traditional stocks. It floods risk assets, especially crypto. Crypto markets historically thrive on liquidity cycles. When money is tight and rates are high, people play defense. But as soon as that tide turns, Bitcoin, Ethereum, DeFi protocols, NFTs, they all tend to benefit disproportionately. Add in the fact that crypto has matured massively since the last cycle, more institutional involvement, regulatory clarity in certain regions, growing L2 ecosystems, and you've got an even stronger foundation ready to catch that upswing. Bottom line, this rolling recession may feel like a headwind now, but if people like Cathie Wood and other macro analysts are right, the stage is being set for an economic environment where crypto doesn't just recover, it accelerates dramatically. Now, beyond just interest rates and liquidity, there are some specific policy catalysts lining up that could pour even more fuel on the fire. First, let's talk tax cuts. There are several proposals floating around right now that would directly increase disposable income. Things like eliminating income taxes for people earning under 150K, cutting taxes on overtime pay, or reducing taxes on tips and social security. While there's still a lot of debate about whether all these proposals will pass in their entirety, even modest versions of them could put billions of dollars back into the pockets of everyday people. And history shows us exactly what happens when that occurs. More consumer spending, more risk-taking, and yes, more money flowing into speculative assets like crypto. But it doesn't stop there. For the first time, we're seeing serious discussion at the federal level about establishing a Bitcoin strategic reserve. The idea that the US would actively accumulate Bitcoin, similar to how countries hold gold reserves to strengthen their financial positioning. While it's still in its early days, even the fact that this conversation is happening signals a major shift in how governments are approaching crypto. And it's not just the US. Several states, Texas, Florida, Ohio, are already introducing their own Bitcoin reserve bills, pushing for policies that integrate crypto more deeply into local economies. Add to that the recent wave of ETF approvals, new pro-crypto leadership in regulatory bodies, and proposals for altcoin ETFs, and suddenly, you've got a policy environment that's far more supportive than anything we've seen in previous cycles. What does all this mean for you though? It means that crypto space isn't just being driven by speculation anymore. There are real, tangible tailwinds forming at both the retail and institutional levels that could accelerate adoption and drive serious capital into the space as all these policies begin to roll out. Now, if there's one factor that consistently drives market cycles but rarely makes the headlines, it's global liquidity, specifically the M2 money supply. For those unfamiliar, M2 tracks the total amount of money circulating in an economy, things like cash, checking accounts, and savings deposits. Think of it as oxygen markets need to breathe. When M2 expands, there's more cash sloshing around, looking for places to go. And historically, a rising M2 leads to higher valuations across the entire board. Stocks, real estate, and most importantly for us, crypto. Here's a real-world example. Between April 2020 and April 2021, the US M2 supply grew by nearly 25%, one of the largest spikes on record. What happened during that same period? Ethereum went from under $200 to over $4,000. Solana, same story. It 50x'd as liquidity poured in. Not because of luck, but because when there's more money in the system, it has to find a home. And risk assets like crypto are prime destinations. But what's key here is timing. Liquidity shifts don't instantly hit markets overnight. There's usually a lag, often 2 to 3 months, between when M2 increases and when asset prices react. Recent data shows M2 growth resuming, albeit gradually. Financial conditions are loosening, inflation is cooling, and governments are rolling out growth-friendly policies. That liquidity wave is building, quietly but steadily. In fact, we're already seeing early signs of this. Stablecoin volumes, particularly USDC and USDT, have been steadily rising in recent months, and on-chain activity is starting to pick back up. It's quite subtle, but these are often the first signals that capital is preparing to flow back into crypto. Let me know what you think in the comments. Do you think we'll see that same liquidity-driven crypto boom like we did in 2020? Or do you think that things will play out differently this time? Alright, so with all these macro tailwinds lining up, liquidity returning, policy shifts underway, potential tax cuts, rate cuts on the horizon, the real question is, how do you prepare for what's coming? Here's how I'm thinking about it. First, revisit your exposure to Layer 1 ecosystems. ETH, Solana, and emerging L2s are primed to capture capital flows as the risk appetite increases. Institutional adoption is growing, staking yields are becoming more competitive, and developers are doubling down on infrastructure improvements. Whether you're holding ETH, SOL, or scouting undervalued L2s or other tokens, these are going to be the foundational plays when liquidity ramps back up. Second, keep an eye on DeFi protocols offering stable, real yield. As borrowing costs continue to drop, Lending protocols, DEXs, and liquid staking platforms tend to attract more users and capital. Look for projects with strong TVL growth, sustainable tokenomics, and ideally ones poised to benefit from increased on-chain activity. Third, don't ignore NFTs in crypto gaming. Historically, these sectors lag behind the initial crypto market recovery, but then catch massive waves of speculation once confidence returns. Whether it's blue-chip NFT collections or emerging gaming platforms, they often serve as entry points for new retail participants flooding back in. Of course, no market setup is without risk. Black swan events, whether it's sudden regulatory crackdowns, unexpected macro shocks, or geopolitical tensions, could delay these liquidity effects or temporarily spook markets. But historically, these setups tend to outweigh short-term noise over time, especially in crypto where the market moves faster than most people expect. And lastly, this might sound obvious, but stay nimble. The macro picture is evolving fast. Stay informed, watching for shifts in Fed policy, tracking M2 trends, and monitoring how real-world adoption plays out will be key. You don't need to time the absolute bottom. You just need to be positioned before the wave fully returns. So, to sum it all up, the headlines today might scream uncertainty. Inflation's still high, tariffs are looming, and interest rates feel like they're stuck in limbo. But if you zoom out and connect the dots, it's clear that the groundwork for something big is being laid right now. We've got a rolling recession settling the stage for a potential deflationary boom. Policy shifts like tax cuts and even a Bitcoin strategic reserve are on the table. Liquidity is quietly returning, and history shows us that when that tide turns, crypto is often the first to benefit. The key isn't about predicting the exact moment everything explodes. It's about being prepared before the momentum shifts. So, if you want to stay ahead of these moves and make the most of what 2025 could offer, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. And just one more thing, drop a comment below. Are you focusing more on DeFi, NFTs, or L1 plays as we head into 2025? I'm curious to hear on how you're positioning yourself. Thanks for watching, and I'll see you in the next one.